Okay, so let us get it started with our webinar for today, given that we do have quite a bit of content to go through. So this is an exciting time because for some reason we took a season break and we didn't do any webinars in the first half of the year. We were quite busy with a lot of actually external webinars and commitment. So we are happy to be here today for the first time in 2025 talking about the Malaysia key transfer pricing updates in 2025. So hopefully out of this webinar, you can really learn a few or get a few insights on the updates that was released by IRB as a Christmas present. So before we get started, for those who are new, let us do a brief introduction about our team. So I can see some familiar names, but just for those who don't know me, my name is Adriana Calderon. I'm the director and co-founder of Transfer Pricing Solutions Asia and Malaysia and the technical lead for our Asia business. I have extensive experience in international tax with big four and mid-tier firms, advising multinational companies in the areas of corporate and international tax across South America, the US, Australia, and the Asia Pacific region. I am happy to share that this is my 16-year anniversary in the Asia Pac region and my 10th year anniversary of being based in Singapore, working with multinational companies across the region. Just recently, as Singapore turned 60 this year, I celebrated my first time, the 50 year in Singapore. So very happy to share that. And let me introduce my co-presenter, which is Binjin, who is one of our managers in transfer pricing solutions. He has started his career in 2010 with a big four in Malaysia. He has assisted 2 out of the first 3 unilateral advanced pricing agreements signed with the Inland Revenue Board of Malaysia, as well as the subsequent annual compliance report for the APA sign. He has managed a portfolio of clients comprising companies from a broad range of industries such as automotive, pharmaceutical, electrical and electronics, FMCG, construction and property development, semiconductor services providers, oil and gas, as well as Chinese investors for transfer pricing compliance audits and plannings. He has been invited by companies to provide internal transfer pricing training to stakeholders. So we are very honored to have him here today. So he's the go guy when it comes to Malaysia TP. Either in English or, fun fact, also in Mandarin. So the agenda for today, we will be talking about some of the key changes, then some case study, and some practical tips on how to implement the changes. So the first question is, what is the effective date of the new TP guidance? And the options are date of publication, which was Christmas, 24th of December 2024, year of assessment 2024, year of assessment 2023. So what's the take, Benjin?
Yeah, thanks, Adriana. So even though the new transfer pricing guidelines were issued on 24th December 2024, however, the effective date for the new TP guidelines were effective from the year of assessment 2023, which will align with the new income tax transfer pricing rules 2023.
Okay, thank you very much. So let us start talking about the key changes and what is it that IRB released as new guidance in the new regulations that were issued during Christmas time last year. So we can summarize it in a few groups. So the first one is associated with the definition of control, followed by the TP documentation requirements. Some changes also on methodology and computation of ranges. Some welcome guidance on the simplified approach to low-value intragroup services, which I think was one of the most expected changes that Malaysian taxpayers were hoping for, given that intragroup services tend to be very common in Malaysia. Some guidance on risk and control analysis and its importance when it comes to doing functional analysis. Some additions on intellectual property, which has not been codified or included before. Some additions on business restructuring and as well as cost contribution agreements, which again was not very clear in the old e-tax guide. So, Pinjin, why don't you start explaining to us what's the concept of control and how it has changed, please?
Yeah, sure. So next one, please. Yeah, so in the past, prior to year of assessment 2019, it has been very straightforward that related party transactions or control transactions are only applicable to those entities that you have control for more than 50% of shareholding control. So even though back then there were a lot of arguments about the management control and so on and so forth, however, there were not any precise guidance or any rules or regulations to say that, hey, those under management control are fall under control as well. However, since year of assessment 2019, with the introduction of a new subsection is section 140 capital F3A, so the control definition has expanded to include 20% of ownerships and with certain conditions. These were further explained and described in the current new transfer pricing guidelines. So maybe next slide, please. Yeah, these are the very common control that we have seen in the past or even now that very straightforward. When one company holds the majority of the share of two companies, which is in the example one, you can see that, company B and company C, and you have to, I mean, any transactions between company B and company C are straight away fall under the definitions of control transactions. So as these two companies are commonly owned by company A. Similarly, in example 2, if company A holds company B and company B holds company C, so any transactions between company C with company B or company A falls under the definition of control transactions, and hence transfer pricing provisions apply to the transactions between this group of entities. So these are the very commonly seen, which is, I think our audience wouldn't be surprised with. Maybe the next slide, please, Adriana. Yeah, this is something that we have seen and a lot of clients have queries. How about what if my companies transact with the companies owned by my son, my family members, my wife? So according to the section 139 of the Income Tax Act, those companies that owned by a family member, where you have a family membership, be it uncle, auntie, niece, and nephews, or even grand aunt, grand uncle, will fall under the definition of family relationship, and hence the transaction between the companies owned by these two family member are considered as controlled transaction, and hence the transactions has to be complied with Malaysian transfer pricing rules and apply the arm's length principle. So the next one is the new addition, which more detailed guidance and examples given in the transfer pricing guidelines. So first thing, what do you look at? So when you look at it, whether a person has shareholding in the other person. Okay, so the next question is that if yes, then what would be? If no, then straight away element control does not exist. So the rule of thumb is still come back to that. Do you have shareholding in the other person? If yes, then it depends on how much is your percentage of shareholding. So if you own more than 50%, then element control does exist. If no, if you are owning less than 50%, then the next question is that, is your shareholding at least 20%? So if the answer is no, which means you are holding less than 20%, then element control does not exist. However, if you are holding more than 20%, then you have to meet one of the three criteria listed below. First thing, whether the business operations of the person depend highly on the property right of the other person or third person, which means that are you relying on any intangible property, for example, manufacturing know-how, patent, trademark, trade name of the other person that holds at least 20% shareholding to operate your business? If yes, element control does exist. This is similar to the second criteria, which is the other person or third person specifies or direct that person's business activities, which means that does anyone from the other entity, from the shareholder, could control and give directions to your company's business activities, including, well, they specify that you have to obtain, purchase, procure raw materials from certain suppliers, or the selling price that you're going to sell to your related parties has to obtain their approval before you could transact it. So this will be for under this directs that person's business activities. Or the third one, which is commonly seen, which I believe will happen in most of the scenario, which the shareholder, the shareholder could appoint more than one director or member of the board of director of that person. So in case that your shareholder, even though they hold only 20% of shareholding in your companies, but that shareholder could appoint director or any of the board of director of your company, and hence this will fall under the element control. So any transactions within these two companies would are deemed control transaction and hence required to apply transfer pricing rules. Next one, please. Yep, so this is an example of the condition A where company ABC Co. owns 25% shares of ABC Sdn Bhd. In the event in ABC Sdn Bhd, it requires the patent rights that are granted by ABC Co. to run its business, regardless of what kind of patents, be it trademark, patent, manufacturing know-how, trade name, anything that is granted, then any transactions between ABC Co. and ABC Sdn Bhd are control transactions. So I hope this is very straightforward. So the first thing you have to determine whether the shareholder owns more than 20%. If yes, does it meet any of the condition as listed above? Let's see the next example of list. Okay, this is a very interesting one. Okay, my group Sdn Bhd in Malaysia holds 55% of shares in my co Sdn Bhd, and ABC Co in country A holds 45% of shares in my co Sdn Bhd. My co Sdn Bhd holds 100% of shares in my ABC Sdn Bhd. So the question is, when ABC Co transact with my co Sdn Bhd, does it fall under the definitions of control transactions? Likewise, ABC Co holds 100% of XYZ Co in country B, and XYZ Co transacts with my co Sdn Bhd. So would this fall under the definition of control transactions? Or when XYZ Co transact with my ABC Sdn Bhd, or even ABC Co transact with my ABC Sdn Bhd. So you'll be very interesting to see that the outcome that the explanations given by the IRBs. Oh yeah, not to forget, my co Sdn Bhd has 5 executive directors, of which ABC Co could appoint 2 out of the 5 directors. So apparently, ABC Co would has control element, as it could appoint director in my co Sdn Bhd. So please remember, we have 4 transactions to test here: ABC Co with my co Sdn Bhd, XYZ Co with my co Sdn Bhd, and ABC Co with my ABC Sdn Bhd, and XYZ Co with my ABC Sdn Bhd. So Adriana, maybe next slide, please. Yeah, you could see from here, this is the things that given by explanation given. So for the transaction between my co-syndrome and ABC co-syndrome, ABC co, those transactions are controlled transactions, as my co ABC co shareholding in my co more than 20%, and my ABC co has the right to appoint directors in my co-syndrome Berhad. Likewise, in my co-syndrome Berhad case and XYZ co, XYZ co is 100% owned by my ABC co. So since the first one control element exists in my co-syndrome Berhad and ABC co, so transactions between my co-syndrome Berhad and XYZ co are controlled transactions, as ABC co has control on both XYZ co and my co-syndrome Berhad. However, when the subsidiary of my co-syndrome Berhad transacts with XYZ co, the transactions are not control transactions, as given that the explanation given was the element control does not exist, as there's no direct shareholding between ABC co in my ABC syndrome Berhad. So this is what has been explained in the fourth transaction as well, as ABC co transact with my ABC syndrome Berhad. There's no element control does not exist, because ABC co holds only 45% in my co-syndrome Berhad and does not have a direct control per se. So this is explanations given by the IRS in the latest transfer pricing guidelines.
So I think what IRB was trying to do is to essentially define the concept of control, but also some parameters on the concept of influence, or the possibility of influence, and maybe when, even though there is not fully ownership control because you don't own more than 20%, you still have the possibility to exercise influence under certain parameters. And when those parameters are met, then there is kind of implicit control because of the ability of influence decisions, but that's why there has to be certain conditions for them to be met. So why don't we just go through some of the changes on TP documentation, Binjin, and then specifically what has changed in the new e-tax guide?
Sure. I would say this new transfer pricing guide actually give a very good exemptions to some of the smaller size entities, because in the past we have been hearing from the IRB during seminars or any webinars they attended, they say that so long you have related party transactions, you are subject to prepare a transfer pricing documentations. However, with this new Malaysian transfer pricing guidelines, they actually give some exemptions when your size, your related party transactions amount are less than certain threshold. So first thing, so after we know that how to determine whether control exists, if no control, no related party transactions, hence definitely transfer pricing documentations are not required. So for this chart, all the CTPD stand for contemporaneous transfer pricing documentation. So whoever does not have, although you have a huge group, but you don't transact within your subsidiaries, your companies, hence contemporaneous transfer pricing documentation is not required. Next, are you a permanent establishment defined under the rules and having control transactions? Yes. If you are yes, so you don't go down to see what is your threshold anymore. You don't look at your revenue. You don't look at your amount for related party transactions. Whichever permanent establishment in Malaysia should prepare a full-scale contemporaneous transfer pricing documentations. So if you are not a PE, then you have to there are few things that you could look at. Are you individuals not carrying on business, or are you individuals carrying on business who only engage in domestic control transactions? Or are you person who enter into control transaction but with total amount not more than 1 million ringgit? Or you are companies that enter into solely into domestic control transactions, but both parties, which means you and your related parties, do not enjoy tax incentive, are taxed at the same tax rate, or do not suffer losses for two consecutive years prior to the control transactions. So which means that first thing, so if you are individual but you're not carrying on business, definitely you are not subject to transfer pricing guidelines. You're individuals carrying on business, yes, you are, which means you are reporting Firm B, who only engage in domestic control transactions, then you don't need to prepare a transfer pricing documentations. The third one, person who enter into control transactions with a total amounting to not more than 1 million ringgit. So be it cross-border or domestic, so long your total related party transactions is less than 1 million ringgit, you are exempted from preparing a TP doc. The last one is a bit uh long, but yeah, very easy to understand. Do not enjoy tax incentive. Yeah, we all know Malaysia has a lot of tax incentive like pioneer status, MSC status, or you have claimed a lot of reinvestment allowance, double deduction kind of thingy. So if no, then you are not enjoying the tax incentive. Are you taxed at same tax rate? For example, some companies are SME, which enjoy the SME tax rate. So if we are transacting with companies, although both are SME, but you have a different tax rate, so you are not considered as taxed at the same tax rate. Okay, so be mindful for those who are SME, look at your tax rate and your related party as well, because there will be some, you still enjoy consider enjoying a tax incentive in some certain amount. The last one is do not suffer losses for two consecutive years. This is very straightforward. You just look at your profit and loss in your audited financial statements. Okay, so if you fulfill any of these, then yes, control or your contemporaneous transfer pricing documentation is not required for that particular financial year or year of assessments. Otherwise, if you have met the threshold, so for carrying a business, when your gross business income more than 30 million ringgit and your total cross-border control transactions more than 10 million ringgit, then definitely you're required to prepare a full contemporaneous transfer pricing documentation. This is for those under sales, purchases, and services. For those who say that, hey, my gross business income is less than 10 million ringgit, but then I provide more than 50 million of, or receive more than 50 million control financial assistance, which is in the way of loans, advances, or guarantor. So you require to prepare a full TP doc as well. So for those that, exempted under para 1.5 and exempted to prepare a full TP doc under 1.7, you have the options to prepare a full or minimum control transfer pricing documentation. So bear in mind, so if only those under 1.5 are fully exempted, for those who are exempted under 1.7, you still required to prepare a TP doc, but it will be a minimum TP doc. So the question asks, if I'm being exempted under para 1.5 and TP doc is not required, can the IRB comes in to audit my company? The answer is yes. You are not required to prepare, but your transactions are still subject to the arm's length principles. So please bear in mind and do your own assessment based on this chart, which is available in IRB's website. Yeah, next one, please, Adriana. Okay, very quickly, we could run through the examples here. So you could see that company A, who has a gross business income more than 50 million, with 15 million of cross-border transactions, then you are required to prepare a full TP documentations. Company B, you have 40 million gross business income, your cross-border transaction is 12 million. At the same time, you have domestic transaction of 10 million, you're still required to prepare a full TP doc because your cross-border transactions is more than 10 million ringgit. Company C with gross business income 40 million, with cross-border transaction less than 9 million ringgit, which is less than the 10 million threshold, with a domestic transaction of 10 million ringgit, you are not required to prepare a full TP doc, but you are required to prepare a minimum TP doc. Company D, you have 40 million gross business income, 8 million of cross-border transaction and 15 million of domestic transactions, but you have financial assistance of 51 million. So you're required to prepare a full TP doc for the financial assistance. Likewise, in company E, you could see that the gross business income is only 5 million ringgit and the cross-border transaction is 9 million, which is still below the 10 million threshold, but with a financial assistance of more than 50 million ringgit, hence you are required to prepare a full TP documentations. Company F, the gross business income is only 20 million ringgit, which is below the 30 million ringgit threshold. Your cross-border transaction, even though more than 10 million ringgit, and you have a financial assistance of 40 million ringgit, you are not required to prepare a full TP doc, but a minimum TP doc is required. And company G, your gross business income is only 20 million. You don't have cross-border transactions, but you have a 15 million of domestic transactions, and yet you have a financial assistance of 60 million ringgit. You are required to prepare a full TP doc. So you have to look at few things. If you are services or trading, you look at the first three your gross business income level as well as your cross-border transaction threshold. Whereas if you are looking at financial assistance, regardless of your gross business income, so long your financial assistance exceeded the 50 million ringgit threshold, you are required to prepare a full TP documentations. Yep. Next slide, please. Okay, so as we mentioned that, okay, this guidelines is effective from the year of assessment 2023. So there's one good news about this contemporaneous transfer pricing documentation definition. It used to be contemporaneous transfer pricing documentation is referred to documentation prepared when the taxpayer is enter into a related party transactions. However, now they have defined it as so long not later than the tax filing due date, which means that if you have if your company years end is 31st December, so the statutory filing deadline ideally is 31st July in the subsequent year. As we know that Malaysia always has a 1 month grace period, which means 31st August. So long your contemporaneous transfer pricing documentation is prepared by 31st August of the subsequent year, it will still consider as contemporaneous transfer pricing documentation. And now the transfer pricing documentation must now include the date of completions. So your tax consultant will have to date it when the TP doc was completed. So 7 years of retention period. Okay, I hope everyone is well aware. It's slightly different from corporate tax. With corporate tax only 5 years of retention period. TP doc was once that only reduced to 5 years, and then they revert it back to 7 years because they found that 7 years they need more times for when they do the audit, and hence 7 years retention period is required. Next, please. Okay, so group level information. Previously, we don't really need to include the group level information, which used to be a group master file, but now it's required where you have to precisely do whatever what do you call it, like what a master file would do, but limited to the business segment that Malaysian entity is operated in. So entity level information has been there for since day one. Cost contribution arrangement, you have to indicate whether you have entered into or not. So regardless if you have not entered into cost contribution arrangement within the group, you still have to indicate that this company does not have any CCA in that TP doc. Index to documents, literally a checklist to show to the IRB that, this is the requirements required under the Malaysian transfer pricing guidelines, and which section of this report has contained the information required. Date of completion, as I mentioned just now, and other supporting documents like your calculations, your computations, your agreements, your email correspondences, third-party index whatsoever to be part and parcel of your transfer pricing documentations. Next slide, please. Okay. So what is the penalties? So, okay, non-compliance, which means that if they found that there's some lack of information or incomplete one, they could impose a penalties of 300 ringgit to 10,000 ringgit or imprisonment of up to 1 year. So failure to submit TP doc within 14 days for those audit cases effective from Jan 2021, it will be penalties of 20,000 uh, to 100,000 or imprisonment of up to 6 months or both. So how do they penalize on this 20,000 to 100,000? It depends on how many days delay when you submit your TP doc. So within 7 days of delay will be 20,000. 14 days will be 40,000. 21 days will be 60,000. 28 days will be 80,000, and more than 28 days will be 100,000 for each year of assessment. So if they're asking for 5 years, then depending on how many days you have late, then times 5. So usually when IRB comes in for transfer pricing audit, it will be at least 3 years, and usually will be more up to 5 years. So it depends. So you have to be very, very quickly when they ask for it, you have to submit within 14 calendar days. So any non-compliance with arm's length principle, there will be additional corporate tax payable based on their calculations, and surcharge of up to 5% on the transfer pricing adjustment. Depends on how much additional income that they have adjusted through from the transfer pricing audits. So these are the three non-compliance penalties that we have for non-compliance.
I think what I found interesting is the imprisonment one, because I think if you want to get hold of your boss who is not paying attention to TP and you tell them, well, all the non-compliance, the failure to comply can also have imprisonment for the legal representative of Malaysia in the Malaysian taxpayer, that will definitely capture any stakeholder attention, because there is not many countries that give imprisonment for non-compliance with TPD actually. So
Oh,
that's an interesting point here from Malaysia point of view. So let us talk about methodology and computation, because I think this is one of the biggest changes in the Malaysian e-tax guide, and is the new definition of the arm's length principle, where we have that the common arm's length principle is basically between the 25th percentile and 75th percentile. So the new arm's length range in Malaysia is now from the 36.5th percentile to the 62.5th percentile. So what it means is essentially that IRB has decided to narrow the range. And then what that means practically is that one needs to have the numbers in place beforehand, because increases the chances of maybe having to be or falling outside the arm's length range. So under the new tax guide, no adjustments if the transfer price fall within the arm's length range, which is basically any point between 37 and 37.5 and 62.5. Adjust to the median point if the transfer pricing falls outside the arm's length range. However, IRB may still adjust the transfer price to the median or any point above the median if uncontrolled transactions has lesser degree of comparability. Comparability defects cannot be quantified, identified, or adjusted. No search to support the results. So this is one of the reasons why we always say to companies, it's better to have some sort of data to know where does your result fall within the arm's length range. Because if you don't have any data at all to support, then you open for IRB to determine the arm's length, the arm's length range in whatever way they want, whichever data they have, and then you have no ability to control or understand what's the maximum or the minimum adjustment that you're going to be subject to. So this is important to keep in mind, that under all of these three situations, IRB can adjust to the median or to any point above the median. So if we see the example basically in calculating the arm's length range. So we will have the usual observations of the companies with the calculation of the profit level indicator, and then we will do the 37.5th percentile and the 62.5th percentile. So if the tested party operating margin is between 37.36% to 5.51%, which is the range, the pricing may be regarded to be at arm's length, and keeping in mind, of course, that there is no substantial defects in the comparable company data. So in other words, that these comparables have been selected following the principles that guide the conducting of benchmarking studies in Malaysia. Then you have to do the calculation of the median, which is basically A plus B, which is a deviation of the Excel calculation, which is basically A, which is 37.5, plus B, which is 62.5, divided by 2, and that will be the median. If the tested party operating margin is below than 36.36%, it can be deducted that the pricing is not at arm's length and is therefore not compliant. And in this scenario, a transfer pricing adjustment may be made to the median in accordance with the rules. So in other words, to 4.43% to reflect the arm's length price. So I think this is probably quite significant and is something that all taxpayers need to keep in mind, because we have a total deviation of what the arm's length range used to be as per OECD now in Malaysia. What are some of the other considerations to keep in mind? So we have the fact that there has been some guidance on the usage of Berry ratio to basically make sure that the Berry ratio is only used in particular or under particular scenarios only. So I think what IRB wants is to prevent the misuse of Berry ratio, because Berry ratio is a measure that only kind of assess the return on operating expenses, but it doesn't give any comfort on the level of profitability that the company earn. So with a Berry ratio being being positive, it doesn't mean that the company is highly profitable or industry profitable. So that's why there is a limitation of the usage of Berry ratio. We also have some guidance on comparable searches, where the comparables need to have at least 10% of the tested party turnover. We also have the recharacterization rules, where IRB can recharacterize a transaction as a whole when it's deemed to be artificial. We have that benchmarking data needs to be the most recent data at the time that the search is conducted, and rely on year-to-year results rather than multiple years. So the normal in Malaysia is year-to-year results. Only in exceptional cases, one can use multi-year, but knowing that the multi-year average is something that IRB is likely to reject. What are some of the other changes that are worth looking into? The low value service concession. I think this is a welcome move, because it's the integration of the OECD low value services of 5% markup implemented or being accepted by IRB. So what that means is there is eligible activities that are considered low value or support in nature, which is very similar to what we all know in transfer pricing as routine services, routine being understood as supporting activities to the main operation activities that do not generate revenue. The criteria is that the activity needs to be supported in nature, non-core, and do not require the use of intangible or create intangibles, and do not involve the assumption or control of substantial risk. If these criteria are met, then the service can be priced at a 5% markup on total cost without having to perform a benchmarking. Nevertheless, the taxpayer still needs to have documentation to show eligibility for simplified approach, that services are chargeable and provide a benefit, and that the services charge has been determined correctly. Because remember that when it comes to service charges, the markup is only one aspect of it. And if anything, is in terms of quantum, is the smaller part of the value of the service charge. What is more is important is actually the cost and the cost base and the allocation of the cost if you're doing indirect methodology. And basically, if anyone who has experience in audit will know that usually tax authorities challenge first whether the service is chargeable, two, if the service charge is correctly calculated, and three, the markup. So this concession, what it helps is with the markup only. It's important to look at some of the examples of what activities are not eligible versus what activities are eligible. And the tax guide has an extensive list that if in doubt, one can always refer to it. So if we look at activities that are eligible are accounting and auditing, processing and management of accounts receivables and payables, budgeting, human resources, IT support, legal, tax obligation, general administration. What is not eligible is any services that contribute to the creation of revenue in the business, such as R&D services, manufacturing and production, purchasing activities, sales and marketing and distribution, financial transactions, extraction, exploration, or processing the natural resources, insurance, and no service of corporate senior management. So in other words, strategic management and corporate senior management is not considered low value services. If you tell your CFO or your CEO that he's low value, he's not going to like it. But apart from not liking it, it's good to know that it's not eligible for the low value concession for 5% markup. So if in doubt, always look at the list of activities that are eligible and make sure that if it's not within, ask yourself whether the activity is supporting nature or is revenue generating in nature. One that is commonly mistaken as revenue generating is sales as support is sales and marketing. Sales and marketing is an activity that by nature is not eligible for low value service because it's revenue generating. There is another couple of additional topics that have been discussed in the tax guide. One is pass-through cost versus services. So there is quite good detail on what is pass-through cost and what is not pass-through cost. So the pass-through cost is the cost that has been paid on behalf of the related party. The supplier is a third party that charges a market price, and the related party that pays is merely a paying agent. So there has to be some conditions that are met, that the acquired services are for the benefit of the related parties. These acquired services have been charged at arm's length because it's a third party who is charging it. The group service provider is merely the paying agent and does not enhance the value of the acquired service. And the cost of the acquired service are the legal or contractual liability of the related parties by a written agreement or email correspondence. So the typical example is basically the concept of acquiring software license from Microsoft, where one company over here, A, will contract with Microsoft for software licenses for the whole group, but the services or the licenses are not only for company A, but are also for company B, C, and all the group of the related parties. So in this case, company A may choose just to do a pass-through cost of the Microsoft license to the related parties because company A is operating only as a paying agent and is obtaining the service from a third party. So this is the key, that the original service provider or vendor or supplier is a third party. And if one can demonstrate that there is no services being provided by company A and it's just a paying agent, then you can do just a pass-through cost and it's not a service. A few other topics that were covered in the tax guide is the importance of having the analysis of risk in the context of functional analysis. So making sure that one will identify economically significant risks, that we make sure that address the contractual assumption of risk, that we can identify all the functions that are that support the risk that is being assumed by one of the parties. Basically interpreting step 1 and 3, making sure that one can allocate or make an analysis of the allocation of risk, and pricing the transaction. So very, very important to do a robust analysis of the risk when it comes to functional analysis. So for example, if we were talking about a contract manufacturer, key risk that differentiate the contract manufacturer from other manufacturers, such as product liability. Does the contract allocate the risk to the contract manufacturer or the principal? Who has the functions to control the risk of product liability? Who in substance assume the risk of product liability? Who has the substance, the control and the capacity to assume the risk, and how to price the contract manufacturer relationship based on risk? And this is something that even we have been taking note of, because sometimes in functional analysis, we focus a lot on value activities and value contribution, but not so much on risk. So I think this is a good reminder to address risk thoroughly when it comes to doing transfer pricing documentation. Other specific topics also include business restructuring, where there is an internal, so first understanding that business restructuring is an internal reallocation of functions, assets, and risk within the multinational group, that changes can impact the characterization and profit allocation. So common type of restructuring for manufacturing activities, conversion of fully fledged manufacturers into contract or toll manufacturers or vice versa. For distribution activities, conversion of full-fledged distributors into limited risk distributors, sales agents, or commissioners, or vice versa. And with regards to the management of valuable, unique intellectual property rights, the transfer of either trade or marketing intangible to companies. This is important to keep in mind because we understand outside of the TP world as business restructure may be an M&A or an acquisition, but not the change of functions like the examples that we're giving here. So if there is a change of functions for TP guidance in Malaysia now, it has been understood or clarified by IRB that is considered a business restructuring that needs to be documented thoroughly to justify what's the factual changes in the relationship that allow for a company, for example, to be converted from fully fledged manufacturer to a contract manufacturer. Why is this important from TP point of view? Because a contract manufacturer may earn a lower profit, but a constant profit over years, whereas a full-fledged manufacturer might earn a higher profit, but it might take the market risk. So these changes in the restructuring of a business activity can have a significant impact in the profit allocation. Hence, IRB clarifies that has to be explained. We have a couple of other comments or inclusions in the e-tax guide. One is the inclusion of cost contribution agreements, which is a contractual arrangement between related parties to share the contribution and risk involved in the joint development, production, or obtaining of intangibles, tangible assets, or service. So what is important to understand is that if a company enters into a cost contribution agreement, now IRB has had a whole chapter on this, giving guidance on how it needs to be documented and how it needs to be approached from transfer pricing point of view. Another inclusion is associated with intangibles and DEMPE. DEMPE understood as development, enhancement, maintenance, protection, and exploitation. So the e-tax guide now codified what the OECD already released in 2013 about the key value add activities that need to be understood when there is intangibles involved in a business. So if my business has significant intangibles, I need to go through the process of analyzing who in the organization performed the key value creation activities, which is these 5 in the context of intangibles, to be able to determine the allocation of profits. And before we didn't have it in the e-tax guide, now we have it in full. So we know that if there is intangibles involved, this guidance needs to be followed and understood. And a couple of other topics. One, commodities. Commodities referring to physical products for which a quoted price is used as a reference by independent parties in the industry to set price in independent transactions. So in this particular case, the debate has always been whether the quoted prices can be accepted as a price. Quoted prices being understood as index that are published publicly by reputable reporting agencies like Platts, Bloomberg, Reuters, etc. Can this be used as a comparable uncontrolled price to test commodities? And now what we have is the answer is yes. It can be used because it's basically being widely and routinely used in the ordinary course of business of commodities. And therefore, the COP method using the index price for commodity industries is now codified as acceptable way to price in the context of Malaysian transfer pricing guidance. Last but not least is a welcome inclusion on loans with a detailed explanation of how one needs to approach loans and financial transactions when it comes to pricing it from IRB point of view, and essentially stipulating that one could go through the normal process of step 1, business and functional analysis, step 2, industry analysis, method selection, and market benchmark. And then making sure that there is a contract, a transfer pricing analysis in place, and whether I'm going to use an internal comparable uncontrolled price or whether I have to perform a full transfer pricing analysis. But this is now basically a welcome inclusion as well, because it gives some clarity to Malaysia taxpayers on what is expected from them in the context of transfer pricing documentation. Having said that, what is still missing is a inclusion of an indicative interest rate that IRB should basically make publicly available for small loans. So this is just for information, some summary of what we have spoken so far. Binging, in the last time that we have, can you just take us through some of the key points on the TP audit framework for 2024?
Yeah, sure. Very quickly, so in most of the case, countries will apply the same thing, which is how do they select cases? First thing, they'll do a lot. They'll do a risk assessments where companies with significant related party transactions, rendering services or acquiring services from related party, losses dealing with related parties in low tax jurisdictions, or you have a lot of intangible transactions, then this will be at a higher risk to be selected for audit. Nevertheless, restructuring, if you have underwent restructuring where they could obtain the information from your annual return form, your group website, your annual report, articles, audit history, in any news in the webs or whatsoever, then of course you'll be in their basket for audit as well. Last but not least, when they have received information from third parties, which include foreign tax authorities for, like, for example, automatic exchange of information by country reporting, this is where they could see that, whether the local taxpayer is at a high risk of doing tax planning, aggressive tax planning. So in general, there are 3 types of audits in Malaysia, which is desk, field, and post-audit. So in desk audits, which is very simple and easy to understand, which means that the audit is fully done at the IRB's desk. So anything, they will just communicate with the taxpayer via phone or emails. The second one is a field audit, which the IRBs will be physically present at your premises to do a site visit, interview stakeholders, verifications of physical documents. The last one is a post-audit, which means that when they have concluded the audit for the year of assessment of, let's say, 3 to 5 years, they will immediately open the subsequent year of assessment for an audit to ensure it, because they have still fresh in mind all the information and they have already know the taxpayer, and hence it's much easier for them to do a post audit. So there are three audit phases. In the initial action, which they will request for that when you receive a request for information and letter, you have to submit everything within 14 calendar days. So in the event they wanted to have a field audit, they will issue you another field audit letter to say that, okay, 3 weeks later I will be in your premise for how many days, and you are required to prepare presentation slides. They already prescribe what kind of information they're required in the presentation slides, and you're required to submit such slides to them 7 calendar days before they come in for field audit. So during the visit, they will be entering and inspect all lands, buildings, and places, particularly those companies with that are capital intensive and has claimed a lot of capital allowances. They will examine, retrieve, make copies, ensure that you know what you have claimed in your tax incentive are correct. So they will interview the taxpayer and key personnel as well. They will usually inform you upfront that which department or which head of department they are going to interview. Nevertheless, they could interview anyone that they bump into during their visit at your premises. So they could just interview maybe a manager, even though it's not a head of department, then ask for some information. So in the last phase, which is audit settlement, so currently they have been stipulated that all the TP audit cases has to be completed within 415 calendar days from the audit commencement date. So within that time frame that communications has to be done between you and IRB. Usually will be only one round, which means that after the audit visit, they will issue the audit finding letters and requires a taxpayer to explain to them. So usually there will be only one round of explanations. Thereafter, if your explanation is insufficient to fulfill to clear their doubts, they will just continue with issuing an adjustment letter to you accordingly. So in that last round of chances, you must provide as much as information as possible. So in case the subject that being audited is a domestic transactions, no offsetting adjustment will be given automatically. If you want, the corresponding parties will have to apply for it, and the IRB will come in to audit the corresponding party before the offsetting adjustment is granted by the IRB. So next one is the penalty that I mentioned, I explained earlier, which when you have late for failure to submit the TP documentation within the 14 calendar days. So every delay of 7 days will be increase of 20,000 of penalty for each year of assessments. Okay, and then the last one, Adriana, the concession. Yeah, the concession of penalties under Section 113B, as the transfer pricing rules was gazetted on 29 May 2023. So for accounting period, for those taxpayer with accounting period begins before 29 May will be applicable under the concession of Section 113B. So Section 113B, what is the penalty, which is a 20,000 and 100,000 of penalty for each year of assessment, depending on how many days of delay of your submitting your TP doc. So you can see that when your financial years started on 1st June 2023, there no longer any concession of penalties for Section 113B under this new transfer pricing audit framework.
Thank
I
you,
think,
Benjin.
yep.
I think we can open for some questions, which there is 3 of them. The first one is, who needs to date the local file? Will your local tax advisor need to ask for the local file and date it when assisting with the corporate tax return? So your local file needs to be dated by whoever prepare it. So if you prepare it in-house, then you have to date it before you lodge your tax return, or if you have external party, then the external party will do it. The key here is to make sure that it is dated, regardless of who prepares it, before you lodge your tax return. Is that correct, or do you have anything else? There is another question, which is, what an interesting point, knowing that Malaysia Tax Authority modified the range of arm's length interquartile. Does Malaysia Tax Authority has a high level scrutiny on transfer pricing practices? Not sure what they mean. Do they mean whether Malaysia Tax Authority scrutines? And I think the answer is yes. There is a transfer pricing team, correct, Pinji?
Yeah, there's one huge team under multinational tax branch which only doing transfer pricing audit. Nevertheless, the other branches could do transfer pricing audit as well.
Is there any background reason from Malaysian tax authorities regarding adjustments of arm's length? The adjustment is when your results are outside of the new definition of the arm's length range, which is outside the 37.5th percentile and the 62.5th percentile, or if you don't have any data to support your price. Correct, right? Anything you want to add?
Yeah. So I mean, sometimes that, as mentioned by Adriana, if let's say that even though you have prepared your benchmarking study, so they could assess that whether such benchmarking study or comparable selected is really close to your comparables. If not, they will adjust it to median and above, to median. If your result is fall below median.
Okay. Someone is saying the control definition is direct control and not indirect control, right? No, you have both indirect and direct control, because that's why a subsidiary will be a control party of the immediate holding company and the ultimate holding company, correct?
Yeah.
Someone is asking, any suggestions on updating benchmarking retrospectively? Our original benchmarking were prepared before the interquartile range was changed. I guess in that case, I don't know if the person means that they have had to adjust the benchmarking and do the new, and under the new definition, they don't support the results. Then in that case, what you have to do is potentially retrospective adjustment to the tax return and their voluntary disclosure, right?
I guess what he's trying to say, because this applies to year of assessment 2023. So if you have prepared your TP doc in the previous manner where you're looking at interquartile range of 25%, 75%, you better reassess it using the same comparables, but with the latest year data, which is 2023 of your comparables data, and compute the 37.5 and 62.5 accordingly, because it's the rules and guidelines apply retrospectively for year of assessment 2023 onwards. So anything before that, you still have to negotiate, because prior to 2023, there's no clear definitions of arm's length in Malaysia, arm's length range in Malaysia.
There is another question. If my company is a permanent establishment company, and it only has related party payment on behalf, am I required to prepare full TP documentation with benchmarking? The answer is yes, right? Because permanent establishment, there is no threshold.
There's no threshold, but since you don't have any transactions with your sales transaction with your related parties, I don't think you require a benchmarking per se.
It depends, Benjin. You know why?
Why?
Because it depends on the way she's wording it here. She's just telling us about the payment on behalf. But when it comes to permanent establishment, one thing we don't know is what is it that the permanent establishment do? Because remembering that the permanent establishment has an allocation of profit and expenses out of the principal. So yes, the transaction that she's identifying is payment on behalf, but what we don't know is what's the role of the permanent establishment in Malaysia. So if the role of the permanent establishment is that it does something, let's say sales and marketing, then there has to be a benchmarking to be able to know whether the allocation of profit and loss is correct or not. of revenue and expenses under the permanent establishment rule. Because remember that
Yeah.
the permanent establishment under the OECD or under the separate entity approach for TP purposes, you need to allocate a separate PNL, and that PNL needs to be in compliance with transfer pricing. So I think the focus here for the person who is asking the question, yeah, the payment on behalf is not necessarily the focus or the most important aspect, is the tax position of the permanent establishment. What is the most important aspect of it? So don't be misled, meaning to say the person who asked for the payment on behalf, because they must be more important on the taxable position. I think we have time for one more question. Is there a minimum number of comparable companies needed to be used for benchmarking to get the 37.5th to the 60.75th percentile? I mean, if we go back to TP 1-on-1, and this is where is a bit, is not a one answer because some people may think differently. From TP 101, because of the way you have to do the calculation of the arm's length, my opinion always is that to drive or to be able to calculate a range, you have to have 5 comparables. What's your view on this, Vinjin?
Yeah, I have to agree. I mean, statistically, it has to be 5 at least, right? From a statistical point of view, lah. But in most of the cases, you get at least 8 to 10 because you rely on the same set of comparables in the subsequent years for financial updates. So anything, if one of them does not have data, then you have to your benchmarking all screwed up in the following years.
Mm. Okay, so thank you for that. I think now we are gonna have to close the time because we are a bit 10 minutes already over. For those of you who are following us, we have a few sessions coming. One is tariffs and transfer pricing next month, then mastering transfer pricing in Asia, and the ACC technical symposium. For those who are recurrent participants, please follow our YouTube channel. We don't charge, but we only want likes in our social medias and YouTube. If you have any other questions, here is our details, and we hope to see you in our next webinar. Thank you.